Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Palantir stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Palantir specializes in big data analytics. To put it simply, big data analytics is the use of advanced analytic techniques against very large, diverse data sets from different sources. Palantir conducts counter-terrorism analytics with US intelligence and the Department of Defense. They also work with companies like L3Harris and Huntington Ingalls. Some of its clients are Morgan Stanley, Merck, Airbus, and Chrysler. An example of something they do is helping car manufacturers manage logistics and operations. It works with the National Health Service in the UK. They also work with the National Institutes of Health, which is a part of the US Department of Health and Human Services. Its Foundry division connects various departments for analytical purposes. It helps fintech companies reduce money laundering from crypto transactions. The company is headquartered in Denver, Colorado, and was founded in 2003. The ticker trades on the New York Stock Exchange, Vienna, Deutsche Börse, Zitra, Mexican Bolsa, Bulgaria, and Sao Paulo Stock Exchange. Let's get started with the model. This is a large cap company, 24 billion market cap. They're trading at $12.80 a share, and they have 1.9 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they did have negative free cash flow each year until the trailing 12 months they had their first positive. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative every year. Revenue is the sales for the company, and that grows every year from 600 million to 1.4 billion. This is the company's income statement. The top line is the revenue of the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. An example of this is cost of labor. Revenue minus cost of revenue gives you your gross profit, and that grows each year from 400 million to 1.1 billion. Below that is their operating expenses. Marketing and research and development are big operating expenses for this company. And below that is their operating income, which is negative every year. They only spent 5 million of interest on their debt, which is a lot lower than 2020, although it is higher than 2019 and 2018. Below that is other income and expenses. These are all the gains or losses not part of the company's core operations. An example is an asset impairment. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income, which is negative every year. This is the company's income statement from their latest 10Q, the first 9 months of 2020 versus the first 9 months of 2021, the third quarter of 2020 versus the third quarter of 2021. And the top line is the revenue, the sales. That went up from 289 million to 392 million. Their government revenue is always bigger than their commercial revenue each year. That mainly comes from the US government, also the government in the UK. And commercial revenue is from companies like L3Harris and Chrysler. Here's their revenue by location. It grew in the US from 156 million to 227 million. This is comparing the third quarter of 2020 with the third quarter of 2021. Their revenue grew in the UK and also grew in the rest of the world. And their US revenue went from 54% to 58%. In order to generate the 390 million of revenue, the direct cost was 87 million, so their gross profit was 305 million. And they have really strong gross margins. Gross margin is gross profit over revenue. It's 78%. That means they convert 78% of their revenue into gross profit. The median in the industry is 66%, the average is 51%. They spent 150 million in marketing, 94 million in R&D, and 149 million in G&A. They do have an operating loss, but it's a lot better than 2020. In the third quarter of 2020 was negative 847 million. Now it's negative 91 million. And they only spent 600,000 of interest on their debt, and the third quarter of 2020 was 2.1 million. They did pay 1.4 million of taxes. In the third quarter of 2020, they had a really large operational loss, so they had a tax benefit of 8.5 million, which means their net income in the third quarter of 2020 was $8.5 million better than their pre-tax loss. In the third quarter of 2021, they added 54 deals of at least $1 million. 33 were over $5 million and 18 over $10 million. They added 34 customers in the third quarter of 2021, which gives them 203. That's up from 139 in December 31st, 2020. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash a company generates or loses from its operational business. So you could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. They spend $11.5 million in CapEx in the trailing 12 months. CapEx is investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they did have negative free cash flow each year, except in the trailing 12 months. They had their first positive, $211 million. They're mainly running their business on capital stock. They generated $96 million in 2018, $107 million in 2019, and over $900 million of stock in 2020. Every time a company issues common stock, it increases the shares outstanding and makes your shares less valuable. And it looks like they're trying to pay down their debt. In 2020 and the trailing 12 months, they've paid down a good amount of debt. But they did add $544 million of debt in 2019 and paid down $150 million. So they increased their debt balance about $400 million in 2019. This is the company's operating cash flows from the latest 10Q. The first 9 months of 2020 versus the first 9 months of 2021. And the way you calculate operating cash flow, you start with your net loss, that was $364 million. It looks like they give lots of stock to their employees, because this $600 million of stock-based compensation brought down their net income. And that's a big reason their net income was negative. But it's a non-cash item, so we add it back here on the statement of cash flows. We also have to adjust for changes in working capital. Even though they reported an accounting loss of $364 million, they actually generated $240 million of cash flow. Last year, they reported an accounting loss of $1 billion and only lost $300 million of cash flow. This is the investing and financing sections on the statement of cash flows, and this is the first 9 months of 2020 versus the first 9 months of 2021. They spent $7 million in both time periods in PP&E. They spent $155 million in short-term marketable securities. They spent $51 million in alternative investments. This $51 million was spent on 100-ounce gold bars. Kind of an odd choice for an investment. You don't see that too often. So in their investing section, they had a cash outflow of $216 million. Last year was a cash outflow of $10 million. In their financing section, they paid down $200 million of debt, and they added about $500 million of stock options. Last year, they issued $940 million of common stock. They added $200 million of debt and paid down $400 million of debt. And they also raised $79 million from common stock options. So in their financing section, they had a cash inflow of $274 million. Last year was a cash inflow of $817 million. This is the equity section on their 9/30 balance sheet. They have $2.2 billion for equity. They raised $7.6 billion from selling their business, and they lost $5.3 billion from running their business. Let's look at the capital structure. $2.2 billion of equity, $260 million of debt. They're 90% equity, 10% debt. And they could pay off all the debt with the cash on their balance sheet and still have $2.2 billion of cash left over. And I gave them the lowest whack on Finbox, 7%, and that's a discount rate we're going to apply to the future cash flows. We estimated a little over 3 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 2024. That's $21 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $18 billion. We divide that by 1.9 billion shares. And we get a calculated stock price of $10. They're trading at $13, so they're trading at a 33% premium. It's a sell according to the model. Their revenue is projected to grow 27%. I upped that to 40%. I grew their revenue 40% for the next few years. That's how I got their future revenue estimates. The average company in their industry converts 21% of their revenue into free cash flow. So I multiplied their future revenue estimates by 21%. That's how I got their future free cash flows. The website Simply Wall Street values the company at $11.39. They're also saying the stock is overvalued. 8 analysts priced this stock and the average price target is 21. The low is 18, the high is 25. This is where the stock has been trading since it IPO'd. So there was a fast run up and then it pretty much came down right away. I bought the stock April 1st. I did sell it a few weeks ago at a 20 or 30% loss. So the stock has really struggled. It was moving sideways for about 8 months, But ever since November, it's pretty much all gone downhill. In a couple weeks, they're going to report their earnings, their 12/31/2021 earnings. So if they do beat earnings, their stock price should go up a lot, because it's hard to imagine it coming down that much more, since their revenue is going up and now they're cash flow positive. The stock has gone down 58% in the past 52 weeks, while the S&P is up 19%. The 52-week low is 12, the high is 39, and the stock is trading well below its 50-day and 200-day moving average. This stock is really popular. Over 60 million shares have been traded on average the past 10 days. So there's lots of bottom feeders out there. Of the 1.9 billion shares outstanding, 1.6 billion are on float, 32% are held by institutions, and 5.5% of the shares are shorted. Their employee count is up a little the past year. They currently employ 2,700 people. If you invested $10,000 into this company when they IPO'd, you'd be at $14,000 today. So the stock is up from its IPO price. But if you sold after a couple months of owning it, you would have more than tripled your money. In the past year, there's only been insider selling, no buying. So you can see every quarter somebody sells. Here's a list of the insiders that sold in the past year, the date, the name, the shares, and the price. I'm sure everybody that sold is happy because they all sold at a profit compared to today's price. Half the shares are held by the general public, 31% by institutions, 11% by insiders, and 4% by public companies. The well-known entrepreneur Peter Thiel is the biggest shareholder at 6.9%, then Vanguard, BlackRock, Sampo Holdings, and the CEO of the company. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They have a really high price of sales of 17, that's stock price over sales per share. That means investors are paying $17 for $1 revenue. And they also have a high price to book of 10.9, that's stock price over book value per share. Let's look at their non-current assets. 29 million of property and equipment, 47 million of restricted cash. This is cash that's set aside for a specific purpose, like to acquire another company. 221 million of operating leases. These are the leases on its buildings or its equipment, and 116 million of other. They have a high current ratio of 4.1. That's current assets over current liabilities. And they don't have any inventory, so their quick ratio is also 4.1. Let's look at their current assets. 2.3 billion of cash. So they have a ton of cash on their balance sheet. 41 million of restricted cash. 174 million of accounts receivables. This is how much money other companies owe Palantir. 148 million of marketable securities. These are short-term investments like commercial paper. And 112 million of prepaid expenses. This means the company made an advance payment for a product or service they're going to receive in the future. Let's look at their current liabilities. 17 million of accounts payable. This is how much money Palantir owes other companies. 179 million of accrued liabilities. This means Palantir has incurred expenses, but it hasn't paid it yet. Payroll is a common type of accrued liability. 208 million of deferred revenue. This is when companies prepay for products or services they're going to receive in the future. 230 million of customer deposits. These are just cash deposits companies give Palantir so they can get started on a project. And 44 million of operating lease liabilities. This is how much money they owe on operating leases. They generated over 200 million of free cash flow in the trailing 12 months, and they have over 2 billion of working capital. So they do seem to be really well funded. They should be able to get through the next 12 months without adding any debt or equity. The best way to look at ratios is to compare them to companies in the same industry. There are 117 companies in the same industry as Palantir. And Palantir doesn't spend that much in CapEx. They have a really good debt to equity ratio. They don't pay a dividend. They generate a lot less free cash flow than the average company. And they rank 13th in market cap out of the 117 companies. The average is 32 billion. Their market cap is 24 billion. And their price to book is a little better than average. Since they have negative earnings, we can't look at the PE ratio. They have a terrible price to free cash flow ratio. And their price to sales is 17, the average is 10.5. And they generate a lot less revenue than the average company. But a company like Microsoft really drags up the average, 184 billion of revenue. The average is 4 billion. So to summarize, I have them trading at a 33% premium. Lots of investors have difficulty really wrapping their heads around what they do. A lot of it is pretty vague. I kind of get an idea from reading through their presentation, but it's not as clear as other companies. The reason I initially invested in them was because of Peter Thiel. He's really successful, and he has a lot of connections. Maybe it was a bad move by selling my stock, but I just didn't see this moving for a while. I may be totally wrong on this. Of course, only time will tell. I rank their free cash flows 5 out of 10, their revenue 8 out of 10, and their ratio 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.